Hello, everyone, and thanks for joining us tonight on the City of Greater Bendigo presenting an information session on the windfall gains tax. So firstly, I'll start by introducing myself. I'm going to try and host tonight, and they're in our web platform, and it's going to be recorded throughout through the entire session as well. So before we get into some other introductions, I might hand over to City of Greater Bendigo Mayor, Councillor Andrea Metcalf, to officially welcome the event.
Thanks very much, Ben. I really appreciate being here tonight, and I'd like to acknowledge that the City of Greater Bendigo is on Dja Dja Wurrung and Taungurung country. I'd like to acknowledge and extend my appreciation to the Dja Dja Wurrung people, the traditional owners of the land that we are standing on today. Today, we pay our respects to leaders and elders past, present and emerging, for they hold the memories, the traditions, the cultures and the hopes of all Dja Dja Wurrung people and Taungurung, because I'm assuming there'll be some from Taungurung country as well. We express our gratitude in the sharing of this land, a sorrow for the personal, spiritual and cultural costs of that sharing, and our hope that we may walk forward together in harmony and in the spirit of healing. I will say, Ben, that the idea for this webinar came from the Farming and Agribusiness Advisory Committee and our Rural Communities Committee. So I just want to say thank you to them for coming up with the idea of having a webinar on this topic. And I know it is jam-packed, so I'm going to leave it there and hand back to you, Ben. Thank you, and I hope everyone finds the session really informative.
Thanks a lot, Andrea. And as you said, it's really good to get some feedback from some of these advisory committees that council has on what's important for not only residents but businesses and other members of the community. So it really did start the process for us tonight to get some experts in the field to talk about this new tax and how it is going to affect people. And we've got a couple of local businesses to come here and talk tonight, in Dennis from AFS and Associates, and also Mark from Beck Legal. And before we do this, the format tonight is obviously online and going to be recorded. And what we're going to encourage everyone to do is to do question and answer on the bottom of the screen. They'll come through here, and at the end of the session, we'll be able to go through and answer the questions at the end. If anyone does have any difficulties with that, you can put up your hand and I'll be able to access it when we do get to later in the question. So before we do that, I will firstly introduce you to Mark.
Thanks a lot for that, Ben. We've been very happy to be invited to speak here tonight. This new windfall gains tax is a very major piece of law that's affecting our primary producers in the City of Greater Bendigo, but also our private property developers as well. It was a tax that was thrown on everybody's head in May last year, and we've been waiting since then to get some more detail around what it actually means, and we finally got that detail late last year, and everyone's starting to make sense of it now. So I'll just take some time here to share my screen. All right, so I just have to start, obviously being a lawyer, I do have to put a bit of a disclaimer in tonight, just to say that everything that we're talking about here is obviously provided in a general overview of the topic. It's not meant to substitute for specific legal advice. Obviously, when you do have your own individual circumstances, we highly recommend that you come and see a lawyer, whether that's us or a regular lawyer that you're using, and also involve your accountants as much as possible and as early as possible. Okay, so I'll just start with a pretty simple overview of what the windfall gains tax is. I assume that everybody here has, pardon me, has some idea and interest in it, given that you've attended tonight. But we'll try and keep it as simple as possible in the limited time that we've got. It is a complex tax, and there are still some grey areas that we're waiting for some definition on. But we'll try and give you as much detail as we can tonight. So, at its simplest, this is a new tax on the value of rezoned land in Victoria. It's quite a high tax. It's based on 50 to 62.5% of the value of rezoned land, and it applies to any land that is rezoned in Victoria. It's not just the typical greenfield residential subdivisions that this would apply to. We're talking about even small rezonings in any parts of Victoria. It applies where there's an increase in the value of land after rezoning occurs, where the value of the land goes above 100,000. So there aren't too many too many rezonings that go through that result in an uplift below this amount. So we need to operate on the basis that it will apply to pretty much every rezoning. Where this tax has been most controversial is that it's effectively a tax on unrealised capital gains, which occur after rezoning. And most, as I said, most rezonings do involve an increase in value, and that increase is immediate when a rezoning does occur. So, oops, sorry, I've gone to the end. There are some rezonings that this tax will not apply to, but they are pretty limited. I thought I'd just take you through some of those now. Rezonings between schedules in the same zone will not attract the tax. So that's effectively, the examples there are a neighbourhood residential to a general residential. So if you're staying within the same zone, residential, commercial, industrial, the tax won't automatically be paid or payable. What this is trying to achieve is a tax on change in use from things like farming to a residential, or an industrial to a commercial. There are some limited exemptions for Melbourne properties, so properties that are already in the urban growth zone, which the GAIC, or the growth areas infrastructure contribution, is payable on. Those properties will not attract WGT. Rezoning to public land also won't. And there's also a general catch-all, which we're hoping will be of benefit for the regions in the future, for rezonings which are excluded by declaration of the Treasurer. I'll talk a little bit later about how the regions may be copying or a disproportionate whack of this tax. So we'll see what the Treasurer has to say in the coming years about types of rezonings which won't be affected. At the moment, we haven't had any indication about what those rezonings will be. The key question around who pays this tax, the answer is pretty simple. It's the owner of the land at the time the rezoning occurs. They're liable to pay the tax in full. So if you're an individual on title, it's a liability that you'll incur individually. If there are multiple owners on the title, it's a joint and several liability. Land which is held by trusts, the trustee themselves will be liable. And land that is held by related companies or trusts are subject to grouping rules. So we often see family farms which are owned by multiple farm members and their trusts. If those parcels are going to be part of a rezoning, they'll be all grouped together, and then all members of the group are jointly and severally liable for their proportion of the tax. There's a simple calculation that we need to consider when we're trying to calculate what the tax outcome actually is. The first step is to calculate what's called the aggregated value uplift. So that is the difference between the capital improved value of the rezoned property immediately before the rezoning and then after the rezoning. So what we refer to there is CIV1 and CIV2. Those valuations are undertaken by or on behalf of the valuer general. This is going to be an area of quite a lot of controversy and dispute in the coming years, because parties will obviously have an interest, or landowners will have an interest in achieving a high CIV1 value and a low CIV2 value in order to try and minimise their tax liabilities. When the laws were initially announced, there wasn't going to be a mechanism for disputing The valuations, the Valuer General was to obtain. Fortunately now there is a mechanism, but it is limited. It's a period of 60 days after an assessment is issued by the SRO after the rezoning. We'll come to that a little bit further on in the presentation. There are the second step there are some deductions which are allowable. Unfortunately, they're not actually known and specified in the legislation as it has been passed. They will be announced in regulations in the future. It's important to note that this tax will apply to all rezonings which occur from 1 July 2023. So we expect to have the regulations around what will be allowable deductions well in advance of then. Expect that they will be the usual planning costs that landowners or their appointed developers incur when achieving a rezoning. So that's engaging their town planners, their lawyers, and perhaps even barristers when they're looking at planning panel hearings or heading into VCAT. And then the last step is multiplying it by the applicable tax rate. So it's a question of working out what the taxable value uplift is after the rezoning, and when you've considered the CIV1 and CIV2 valuations. The first $100,000 in uplift won't be taxable. The next $400,000 is taxable at a rate of 62.5%. And then after that, the 50% of the taxable value uplift will be used to form the tax rate. So as I said, it's quite a high tax rate, and it becomes payable immediately, subject to some deferring rules. So as I just said, the WGT is payable at the time of rezoning. Once the rezoning occurs, the SRO will be issuing assessment notices to all landholders who own parcels within the subject land. The owner then has two options. One is to pay the amount in full within 30 days. I'd be surprised if any owner does that, because there is a deferral mechanism which is available here. The owners can defer payment of all or part of their liability by responding back to the SRO within 60 days of receiving their notice. Deferrals are available currently in metropolitan areas for the growth areas infrastructure contribution. If anyone watching is familiar with how GAIC works, it's a similar model for the WGT, but it's not quite the same. The WGT can be deferred effectively once, not multiple times, as it can be for GAIC. And it can be deferred until the first of the following events. So the words that are highlighted here in this slide are words that are quite commonly used in the Duties Act. So the first of the events is a dutiable transaction. So that's just most commonly a sale of the land or a transfer of the land. That can be to a third-party purchaser for value, or it can be to a family member for value. Otherwise, relevant acquisitions are captured. So that's sales of shares in landholder companies, or if they're owned by trusts, most commonly unit trusts, sales of units. If none of those events occur and 30 years passes after the date of the legislation, the windfall gains tax becomes payable in full. I'd expect that if there are some properties that haven't been rezoned by that point in time, that that would be extended out further on. The industry or the government has responded to industry pressure around giving landowners an ability to actually fund the payment of this tax. So if the land sits there for 30 years, we would expect that there's some mechanism, or that there would be some mechanism in the decades to come. When you do defer, interest is payable. That's the usual part of the growth areas infrastructure contribution as well. It's quite a low rate. It's at the 10-year bond rate, but it will keep accruing until the tax has been paid down. In allowing you to defer, the SRO will hold a first charge over the land. So what that effectively means is that they'll register a notice on the title, which will prevent you from transacting on the title until the windfall gains tax has actually been paid out in full. It won't preclude you necessarily from being able to obtain finance on the land, but it will mean that before you transfer the land and sell it out, whether you're transferring to a family member or you're actually developing and subdividing, the WGT, which is attributed to that parcel, will need to be paid. If the land is subdivided, the WGT is apportioned across the lots which are in the subdivision based on area. Now, there are some, and this slide relates to the deferral method, but there are some dutiable transactions and relevant acquisitions which won't mean that the deferral ends. So you will be able to have what's called an acquisition of an economic entitlement. So this is relevant for landowners who might be discussing plans with a developer to come in and develop their land. When a developer does that, they generally have to pay duty on the share of profits that they receive from entering into that agreement. That's called an economic entitlement. And the State Revenue Office recognises that they'd be getting 2 hits of duty or tax effectively if they were to get duty on the economic entitlement as well as WGT. So entering into a development agreement doesn't trigger the WGT. Nil consideration transfers. So this is interesting from the point of view of family transfers. When land is being gifted between family members, it's often for no monetary value. And the law recognises that those transfers shouldn't trigger the windfall gains tax in full. But the transferee in that instance must elect to defer the WGT. Transfers within deceased estates will be okay as well. So if you've got a parent who passes, the transfer in within the estate to the legal personal representative or the executors of the estate won't trigger the WGT, and transfers of land between charities as well. Some relevant acquisitions which are excluded. So the first one there is an acquisition in a landholder due to a pro rata increase. So if there's a share issue within a company, but all shareholders are receiving the same proportion of shares in accordance with their original shareholding, that won't trigger the tax. And then there's relevant acquisitions of further interests in companies or trusts. So if you are taking a further interest from another shareholder or unit holder, landholder duty is already payable on those types of transactions. So again, the SRO doesn't double dip and will allow the windfall gains tax to be deferred and sit on the land. There are other broad exemptions. The first one listed there has been of most interest to most landowners and developers who are dealing with the new landscape with the WGT. So there's a residential land exemption for dwellings and 2 hectares around the dwelling, which will be excluded from the valuation for the CIV2. So if there's a dwelling which is capable of being occupied or for which a building permit has been granted, then the 2 hectare exemption will apply. Importantly, it doesn't have to be a principal place of residence. So if you've got farming property, for instance, which does have several dwellings, which is quite common, you'll be able to use that exemption multiple times. We have seen some deals in the last 6 months where parties are looking to obtain building permits in order to try and minimise the tax. I think that's going to be an interesting area to explore. Again, the charitable land exemption exists, but it's important to note there that it has to be used or have been used for a charitable purpose for at least 15 years. Rezoning errors do occur, historical areas that need to be fixed up for an odd or an incorrect zoning outcome. That won't trigger the windfall gains tax. And then there's some transitional exemptions as well, which have been quite interesting to deal with within our industry in the last 12 months. So if you had an option or a contract in place before the laws were originally announced on the 15th of May 2021, and under the contract or the option, the rezoning would happen before the settlement of the contract or the option, the WGT won't be triggered and won't apply, which is a really fantastic outcome if you're lucky enough to be in that circumstance. If you've got a long-term contract in place at the moment as well, it's important to note that if you are looking to amend that contract to try and fall within the exemption for WGT, they've closed that loophole in that the contract date, if there's any variation after the 15th of May 2021, the new contract date will essentially be treated as the date for assessing whether the exemption applies or not. So that's an unfortunate gap that has been closed. Rezonings that were underway before the 15th of May 2021 as well are exempt if the rezoning happens after 1 July 2023. So in those cases there, you will need to demonstrate to the SRO that you had a serious rezoning application underway. That would involve either engaging with council, employing consultants to assist you with the rezoning, or to have taken some, or actually made the application itself. So there are some high evidentiary burdens to meet there in order to obtain the exemption. So just wrapping up and some key points. These are really onerous laws. They're in some ways, the way they've been announced is has been a little bit difficult to deal with, but we are starting to get our heads around them now. The industry's adapted in the last kind of 3 or 4 months to start treating the windfall gains tax as effectively a development cost. But it's important as landowners to know that there are some structuring options available to you, which Dennis will talk about in his slideshow a little bit later, in order to either remove the WGT or at the very least minimise it. The exemptions, though, are pretty minimal, and it doesn't apply just to your typical greenfield developers who are used to government taxes being imposed. It's going to apply to anyone who's trying to do even a minor rezoning, perhaps of a commercial property that they own to make a small residential subdivision, perhaps. It's very broad in application. When you're involved in the rezoning, it's going to be important to know you've got very limited options and a very limited time frame to object to any valuations which the Valuer General obtains. The SRO often does have discretion to consider applications or requests out of time. But in this case, it's been made very clear in the legislation that the 60-day time frame to object is it. There won't be any ability for any parties to make any requests for the Commissioner to exercise their discretion. If you're a landowner and you're involved in the negotiation of a long-term sale contract or perhaps a development agreement for your land, where rezoning is contemplated as part of that development, the WGT is going to be an inescapable part of the negotiations that you have to deal with there. We're seeing in the work that we're doing for our clients in the last 6 months, there's been an effect on sale prices during negotiations and also effects on the terms of development agreements that are being entered into. So depending on which party is willing to effectively bear the liability for the windfall gains tax, those agreements are being heavily affected by the laws now. And the last point that I'll just make there is that being in the regions as we are, there is a school of thought at the moment, which I tend to agree with, around regional properties actually being a little bit disadvantaged. The GAIC exemption that is available to Melbourne properties means that WGT isn't paid on that land, but unfortunately regional properties don't attract GAIC at the moment, and the GAIC rate is much lower than the tax rate that the WGT will impose. So there's a real concern there that affordability in regional areas is going to be adversely affected. So the run that we're seeing on people to the regions now may be affected by the outcome of the WGT, simply because housing affordability will become less in the regions. So hopefully that's obviously not the outcome. That's all from me for my slides. I'll hand it back to you now, Ben, and happy to take questions at the end if anyone's got any from the material that we've talked about.
Thanks a lot for that, Mark. It was very informative, and as you did mention, we've got a few questions that have come through in the Q&A box. Some might be answered, and I reckon Dennis might pick up a couple of them as well. But please, if you've got anything that's front of mind at the moment, or something comes up as Dennis goes through, I guess from an accountant's point of view over the next 15 or so minutes, put them into the Q&A box. They'll come through, and the panel can have a look, and we can definitely answer them at the end. So appreciate the work that goes in prior to the meeting today, and I guess your informed info on this, Mark, was great. So now I might hand over to Dennis Barnett from AFS and Associates to talk about, I guess, the accountant side of how this tax will affect, and maybe even some tips on how we can manage it.
Thanks, Ben. And thanks to Mark. I just want to touch on your last point, Mark, around the impact on regional Victoria. This tax will have impact on two classes of people, one being the landowner and one being the regional Victoria as a whole. It is unfairly geared towards taxing regional Victoria, and as a result, we will see the uncertainty around what the land may be revalued at, possibly push developers to pay premiums for land that's already rezoned in the classification they're looking for. And we'd also expect, with the implications of windfall gains tax, that tax will be passed on to the purchaser, and therefore house and land packages may become uneconomical. Their house prices will go up, and land prices will go up. So there are broader ramifications as a community and as a regional centre. And tonight, I suppose what I wanted to talk about was not necessarily the impacts on the region, but more the impacts on the landowner and where accountants fit. So Mark went through comprehensively on how the windfall gains tax applies and who it's relevant to and what the rates are. And when you consider the information Mark provided, you might question where the benefit of an accountant being involved is. It's critical that as soon as you go down the path of thinking of rezoning, or a developer approaches you as a landowner, that you engage with your accountants, your lawyers, and trying to determine what is the best outcome to minimise the overall tax. There's very little you can do to minimise the windfall gains tax, as Mark alluded to. So it's that broader tax picture that we can look at and see where we can go from there. So tonight I thought what I would go through is just a bit of an example. We have the benefit of working with a number of clients, and so I've taken a couple of generic bits of information on some circumstances, and I hope it sort of highlights exactly how this might impact the landowner. There's also one of the questions that has come up. I've been watching the Q&A as we go, and I think it's probably fairly relevant to address right now, and it's the impact of the windfall gains tax on the capital gains tax outcomes from the sale of a property. So there's two things that matter here. The first is it classified as being on revenue account? And so that's you're in the business of property development, or are you holding the land on capital account? Now, there's been no correspondence from the ATO yet around the deductibility of the windfall gains tax. However, what we're expecting is that it will form part of the cost base of the land. And specifically item 4, when you're trying to work out the cost base of your assets. So we will expect any windfall gains tax that is applied to you will actually be increased on your cost base and therefore reduce your overall profit on the sale. So I'm just going to jump in and share the screen. And so right now, just a couple of different scenarios and examples. And the background on this one is it's a farm that's been in the family for 30 years and it's 20 acres. So I've been fairly deliberate with some of the information in here just to start to get some consideration around items that might be relevant. Now, 30 years puts us outside the capital gains tax rules, so the property will be subject to capital gains tax. 20 acres may not seem to be large for a farm, but depending on what you're farming, it can be quite viable at 20 acres. In this case, the owners of the land are approaching retirement and a developer has approached them to buy the land. So at the moment, the land has a market value of $800,000. So I think generally, a lot of those conditions there might be applicable to most. So in this case, we're going to start with looking at 2 options. The first is we're just going to do a straight sale of land to the developer, or the second is to rezone the land first and then sell. So as I alluded to at the start, we expect that developers, where land will fit within growth zones, they may be expected to pay premium prices, particularly if it is zoned with the right classification to begin with. But in this one, I've just said, well, the land's worth 800, the developer really wants it, so they've offered 850,000. Very simple transaction. There's no windfall gains tax because there's been no rezoning, and therefore the sellers walk away with 850,000. The planning opportunity here is around how the land has been used, how long it's been owned for, what it's been used for, and for how long. What was the original purchase price of the land? Typically where a farm has been owned for 15 years and the owners apply or qualify for the small business concessions, there's the ability to potentially exempt some or all of the gain from capital gains tax. So your first opportunity to engage with your accountant at this stage is around what is the impact with you and can there be anything done to minimise the overall capital gains tax. There are a number of concessions and it's making sure you're eligible and able to access the ones that provide the most benefit to you. In the second scenario, I've put forward that we're actually going to rezone the land prior to selling. So the rezoning has generated an uplift in value of 100%. That 100%, depending on the area, could be quite normal. In the examples provided by the state government, they're talking rezoning increases of up to 400%. Quite impractical for, I think, a lot of our area, however, not unrealistic. So with a 100% uplift in value, we've got a windfall gains tax of 400,000, and I've allowed rezoning costs of 140,000 there. So net proceeds before tax at 1.06 million. So if you're talking to your accountant through this stage, you have the opportunity to work out what's going to provide the most money in your pocket, because typically if we're retiring, we want to do comfortably. So just by having the conversation with your accountant in this scenario, you potentially walk away with an extra 200,000 in your pocket on a very simple transaction. Although rezoning isn't necessarily a simple process, by using skilled and expert advisors in that, it definitely does make it much easier. What we're seeing at the moment is developers actually approaching landowners and asking to enter into a joint venture with them, or a partnership, for want of a better term. And so I've just explored that to some extent down this track as well. In this regard, the developer is actually asked to do a development with the owners by way of a joint venture. And the developer has said, if the land's worth 800,000, I'll contribute costs of 800,000 as well to make us a 50-50 arrangement. Now, under a 50-50 arrangement, if we simply took the land value and the rezone development costs as being 800 and 800, it's all fairly square and even at that point. And if you look at a contract purely based on how much they're contributing and your current situation, it might be quite easy to think, okay, everything's fair. But if we look down, we're converting the land to a total of 4 million in sale proceeds, so 2 million each. Because of the windfall gains tax, the land actually hasn't transferred or the windfall gains tax hasn't been triggered with a developer coming in. Typically, it's a joint venture, it's a separate agreement, but the land stays with the current owner. So in this case, if you were to retain the land, the windfall gains tax would be levied completely with you. And so your 2 million would be reduced by the 400,000 in windfall gains tax. And your net proceeds before tax is 1.6 million. And just for comparison, I've put on the right-hand side of the screen the impact on the developer being 2 million in sale proceeds less the 800,000 in development costs. So the opportunity to, again, engage with your advisors is around trying to make sure the deal is structured in such a way that it's the best outcome for you. And I've just changed it slightly in including or incorporating the windfall gains tax. And there's a couple of different ways this can be done, whether it's a joint venture or the creation of a new company. The opportunity to share that windfall gains tax and make sure it's a legitimate expense realised by both parties. We can still maintain that 50-50 ownership, but we can see that the costs to the landowner are halved because the windfall gains tax has been shared. And so again, just in this scenario, it's a $200,000 advantage to the landholder. So what we're seeing is a really great opportunity to work with developers. Developers have been up until this point very keen on exploring the areas around Bendigo. And the way they're putting together deals and arrangements, certainly many and varied. There is no one rule of thumb developers are taking at the moment. They're certainly trying to make sure they maximise their returns, and it's critical that you as landowners also maximise your own. So engaging early with advisors, thoroughly recommended. And if you can structure the deal in such a way that if we consider that development or moving into that development option, a real life example of one we've been through is it was a farming land held for an extended period of time within the family. What we did was we maintained the value of the property and still being used as farming land up until when it will be rezoned. And what that does is it up or increases the cost base of the asset. We can sell the land to the new development company at the higher rate, which increases the return to the landowners because they get a greater share. But also it means we get a higher portion of tax-free income. And then on the backside, when the land's sold, we also get a reduced tax there because our cost base is higher. So if there's nothing you get from this tonight other than it's important to talk to your advisors, I would strongly recommend it. Ben, that's it for about me. I'll throw back to you.
Thanks a lot, Dennis, for that. And thanks for the questions that have already come in. We might get Dennis and Mark to join us in a bit of a panel to go through these questions. And please, if there's any more, we've got a couple here to go through, but if there's any more, if you put in the Q&A tab, we can definitely have a look and have some answers. But yeah, thanks, Dennis, for that. I think it's really good. I can talk about the way my brain works. It's really good to see some different scenarios rather than some hypotheticals. So hopefully that helps some of the attendees. So We have an actual hand of Heather. So we might start with Mia, if we can unmute Heather and let her ask the question. We might start with that one before we get to the preloaded questions.
Can you hear me?
Yes, I can.
Thank you. I couldn't write it all down because it was just like getting mashed up in my head. I'm actually a resident of Morong. I'm actually president of the Morong Community Action Group. And my question is really broad around, I understand the developer and the land that's been identified for residential subdivisions. And I do have concerns, as you spoke, around the impact that it's going to have on housing affordability in our community. I'm also concerned how that will spin off into employment and that much broader picture. But my question at the moment is, there is a lot of development identified for Morong. One area is the new Bendigo Regional Employment Precinct. And the second is an area that's identified as for a new school and some ovals and public spaces that are going to all impact on the City of Greater Bendigo. So my question is around, how is City of Greater Bendigo going to have to pay all these expenses, because the land is not going to be rezoned in time out this way before this tax comes into place? How's that going to impact on City of Greater Bendigo? And I guess my other add-on is that we are in huge need of infrastructure for a lot of things to go ahead. So we for that business employment precinct to go ahead, we have to upgrade the water to Morong. We certainly need a lot of work around vehicles moving through Morong. So there's a lot of stuff that needs to go on out here. And then all of a sudden, all this money is going to state government. What commitment is there back to? So I've really got a layered question here. What commitment is there to help us in some of those areas so that we don't become a second-rate community? And what's the impact going to be on City of Greater Bendigo with their plans to develop out this way?
Thanks a lot, Heather. And we might break that into a couple of parts. And I'm probably looking at yourself, Mark, for this, about the treatment of, I guess, the employment precinct, which is now council-owned land, and then I guess the areas earmarked for schools and the rezoning. So we might unpack that, and then maybe to both Mark and Dennis, if there's anything around, has there been anything about, does this new tax go into consolidated revenue, or is there commitment to money coming back into infrastructure? If there's anything that that you may or may not have heard.
Yeah, sure. Really good questions. Thanks, Heather. So just going back to the point that we discussed, any land that's going to be used for a public purpose won't attract this tax. So that's I suppose a key part of this. Council won't be stuck with this liability. The question around...
So that's around the employment precinct?
That will depend how that land is actually zoned. If it's to be zoned within a general, if it's to be zoned differently to as it is now, there is some possibility that that tax could be paid, but it is a tax that's designed on private development. So depends how. I don't know how council's developing that.
Yeah, and I can probably give a little bit more info. Mark's going to help.
Yeah,
so that's land that council now owns that will be rezoned from a farming zone to some form of industrial zone to allow industrial development. So that piece of land, that will be, I guess, the process over the next few years.
Sure. The last question you asked there, Heather, is an interesting one, around what actually happens with this income that the state government will receive. At the moment, there's no obligation to use those funds in any particular way. It does go into consolidated revenue. It's something that the industry is really pushing back on the government to, I suppose, better utilise the funds that are going to be coming here. There is a general school of thought about the way GAKE works, in that it does benefit communities to some degree with targeted policy and precinct structure plans and the like. But at the moment, this tax doesn't require the government to use the funds in the area from which the taxes are paid, which is a very controversial issue.
Yeah, that sounds like a good advocacy piece for not only the City of Greater Bendigo, but I'd say every regional council around the state about advocating to hopefully having some of this money put back into the infrastructure that is needed. So,
and look, it's something that private developers are really interested in as well. If they're going to be picking up part of the tax, they would prefer to see it used in the land that they're actually developing. So we definitely need some guidance and clarity there from the state government.
And are we likely to get that in the short term? How long's a piece of string?
Yeah, it's a loaded question, Heather. We've had a lot of smoke and mirrors, I suppose is one way to say it, from the government about this tax. When it was first announced, it was vague in some respect and very wide-reaching. So I wouldn't expect necessarily to get that indication anytime soon. We do have quite a long lead in time here as well to 1 July 2023. So yeah, I wouldn't be holding my breath.
No. So one of the other questions is that we have a structure plan, or a city council have a structure plan with the planning minister at the moment, and it's being reworded, refined as we need it to. But in the structure plan, City of Greater Bendigo made a bold bid that as such, they would perhaps purchase the land themselves that would become a new school site. And then when Department of Education decided that we were actually needing a school here, that they would then sell that on, because they've already identified a site for as an education precinct, and they were hoping that they would be able to build something like they've done at Marist in Maiden Gully, where council became partnership, and council put in some playing fields and things. So how does that impact with council if they were to follow that plan with the and do that? Because a lot of the residents in there are senior people, and so they're in a situation now where they're finding it really difficult to move forward, because they're getting to a point in their lives where they want to move on, but they've got this structure plan that hasn't gone ahead yet over their heads, and all this other taxes and etc. It's really locked those people into a lifestyle at this moment that they don't want to be.
Yeah, I might just jump in. It's a really good question, and something that I know council will be working through on this particular instance, and particularly for school and public use that I know Mark had used earlier. So on these two particular examples are definitely front of mind, and something that council has a structure plan and will be working on to not only progress what we've got in the structure plan and the employment precinct, but also working through, I guess, the tax implications on this in the particular instance, particularly if it's council purchasing land to then be given to a school. It's something that we'll be working through that particular instance on. So
do you think it'll come under that public purpose land?
I dare say, and I'm happy to be pulled up by Dennis or Mark, but I dare say from a council point of view, that's what we would be pushing for, because it would be for a public purpose. So, okay. But on the individual instance, we'd need to go through probably, like I said, a little bit of information on the run, something we're definitely working through these individual scenarios. So,
okay, thank you. That gives me a little bit of hope. Thank you.
Thanks, Ella. And we've got a couple other questions here we might jump to. So first one I might ask around, we've got one here around, when do you apply for an exemption on the rezoning or the sale?
Yeah, I'll take that one. So you don't necessarily apply for the exemption. If you get a notice and you think your property is exempt, there'll be an opportunity within that 60 days after getting the notice to object. So it's a question of getting your advice if you do receive a notice. I can't stress enough that it's a very short time frame, and the ramifications if you do miss that notice are potentially well, they will be quite burdensome. So the trigger is the rezoning itself. It's not an exemption that you have to apply for before the rezoning.
Thank you. Got one here, which I think I know the answer to, but we'll ask: is this tax only applicable in Victoria?
Yes, this is a state-based tax. Yep.
No.
So there are other states that are looking quite eagerly at this to see how it goes, and looking to introduce things like it themselves.
I've got another one here, and a nice little scenario that's being tossed up on: can a family member transferee who defers for 30 years then transfer the property to another family member within 30 years to defer again? So
yeah, the way it works at the moment, the answer is no. It's the first and only of those three events that we went through in the presentation. Again, a little bit different to the growth areas infrastructure contribution, where you can continue to roll over a deferral on transfers. That hasn't quite happened here.
thank you. And we've got another little question here, a scenario that's been put up of a land purchase back in 2020 with a 4-year settlement agreement. Has then engaged your local council and discussed rezoning in later in that year and again in 2021. Asking, is that saying they will be exempt from it, given that it was rezoned in the next 12 months? So you can see the question there. I think it's around the timing of rezoning some farming to commercial land.
Yeah, look, based on those facts there from Josh's question, which I can see here, there's some really good potential for that to be exempt. As I said in my presentation, it's going to come down to the evidence that you can present. This would involve an application for an exemption to the SRO once an assessment has been delivered. So getting as much detail as you can around what you've done in that period, late 2020, early 2021, will be really important. But from what Josh is saying there, yes, starting that discussion around the rezoning with council, hopefully preferably they've engaged some outside consultants as well. That's the type of evidence that we would need to demonstrate to the SRO. But yeah, all signs looking good there.
Thanks. And I think that's, and a couple of these questions to me are probably really highlighting Dennis's point of, if you're not sure, engage your accountant or your lawyer as early as possible. Make sure you've got your advisors there that are going to be up to speed with things. And that's going to really help in these scenarios and having the timestamps by the sounds of it. So it's probably really, my opinion from what I'm hearing in the last hour or so, and from what everyone else is, if you're not sure, go to your advisor and ask the question, because it could be a very good spend of a little bit of money to make sure that you've got the right answers. So another one, and this has probably got a few different scenarios here, and it's probably yourself again, Mark, around how much notice do you get around the land being rezoned? I guess there's lots of potential scenarios there.
Yeah, there are a lot. Probably an important point here is that you can be dragged into a rezone. You don't necessarily have to initiate it yourself. Typically, you'll get a lot of notice. It's not something that authorities tend to spring on people. But yeah, it's a hard one to answer because every scenario is so different. You won't get a notice about the windfall gains tax being payable though until the rezoning itself has been completed. So rezonings aren't fast processes. Even the simplest ones, you're talking, realistically 18 months. So larger ones where a PSP is involved, you're a number of years in the making there. So it would be hard to imagine a scenario where a rezoning would be a surprise.
Yeah, it's sort of, it's not going to happen overnight. And as you said, a lot of them, not saying it doesn't happen, without the owners sort of being informed. But he said it's not the sort of thing you got to wake up tomorrow and say we've been rezoned and you've got a big tax bill in the mail. It does take a lot of time. So
that's right. Yeah.
And we've got one last question there around growth area and general residential zone. Once again, looks like you're dominating the questions on us, Mark. So
that's okay. So the question is, if council's marked your area as a growth area and a proposed general residential zone, although you are zoned farming and developers are visiting, but with long contracts, how much notice do you get if your properties to be rezoned? We will just, they probably really covered that. How quickly can this happen? So, yeah, again, depending on the scenarios, most developers who are talking to particularly farmers know that they're in for quite a long process. Heather's example around Morong, that's obviously a hotspot for development at the moment. That's going to be a years-long process there. So there is a very, very small opportunity for some owners or developers to try and achieve their rezoning before the laws kick in 1 July 2023. Unfortunately, with the way most rezonings get caught up in the system, and particularly since these laws have been announced, how many rezonings have tried to be pushed through, I wouldn't hang my hat on trying to get a rezoning done by the middle of next year to beat the tax.
Yeah, it's definitely. I can speak on behalf of Bendigo. There's definitely a backlog there of rezonings and plannings, but I know it's a pretty statewide process with a lot happening, working through things. So unfortunately, it's not something you can turn around overnight.
Yeah, that's right.
Really good question here around the regions seemingly being disadvantaged, and is there any mechanism for lobbying state government to move to a more even playing field? Really good question. That I know it's something that councils are doing. I know it's something that developers will definitely be doing. But once again, we're open to the panel, but my advice would be the more we can speak to the local members about it and individual instances. You mentioned, Mark, I guess the flee to the regions is great. We're seeing more people move to the regional areas, but to do that, we need land available and we need land that's affordable to be able to do it. So I definitely, I know it's something that councils will be doing and developers would be individual, done the right way, individual proposals about where it is and what's holding up development. I'd say definitely doesn't hurt in that scenario. Is there anything, Mark or Dennis, from your end? I know most likely the REIV and others will definitely be would be lobbying, but
yeah, look, I think Mark will probably be able to provide a little bit more detail, but I think you're spot on, Ben. I think lobbying local members, when the state government first announced this tax, it was really about trying to level the playing field, was how they described it, and sharing some of the uplift in value with organisations or community groups around building schools, infrastructure, and other items like that. So the best thing that can happen is that people make noise to council, but more importantly, their members. I know council will be talking long and loud about it, but we need to make sure, particularly with Bendigo being a Labor area at the moment, for me, it would seem more as a direct line to have those conversations, assuming Victoria remains a Labor state after the next state election. So just make sure you're asking the questions, make sure you're harassing your local members.
Yeah, it's a really good point Dennis makes there about having insight and availability to Labor members. The private property development industry, the peak body, the Urban Development Institute, has done a lot of lobbying around this tax, and also the social housing tax that was proposed in the last couple of weeks. They've been a loud voice in this front. They've been lucky to get a few small wins, I think, in this windfall gains tax legislation. But in terms of the regions, they do have a very metropolitan focus. We would love to see, we'd love to see our local members in there fighting for us. And I dare say we'll see councils lobbying quite hard. There is that discretion for the Treasurer, as I pointed out. That is a catch-all there. When they drafted this legislation, they knew that there's a lead in time, and there may be some modelling that needs to be considered before we see what the effects are in the regions. So hopefully we'll see some action there in the next year.
Thank you very much. And I want to say, looking at the time, and we just add, I want to say huge thanks to Dennis and Mark for tonight, and for everyone to log in and ask some really valid questions on what is a pretty complex new change in this space that's also come across pretty quickly in the scheme of what we would normally take on things that take a long time. So, Ben, I want to say a huge thank you for bringing your expertise and taking the time tonight in preparation for it. And so this, as it has been recorded tonight, and will be available for anyone to view, or if you've got other people you think they'd be that would get some benefit, to have a look on the City of Greater Bendigo website. But I want to say thanks to everyone for joining tonight. Thanks, Councillor Metcalf, for the introduction earlier, and the Farming and Advisory Committee to raise this idea. And it's something I can say as an economic development area of council, we really want to try and make it help get the info out to businesses and community to make sure we can make educated decisions. So if you took nothing out of tonight other than I'm going to go and call my accountant, or I'm going to call my lawyer because I'm not quite sure, well, then I think we've got something out of tonight. So thanks a lot tonight. And I want to say a special thank you to Sally Beer and the team who's done all the heavy lifting organising tonight. So well done, Sally, for that. And I hope everyone has a great night and got some benefit out of the session. Thank you.